This bottoming in bond prices or peak in yields came in January 20th at the beginning of the Trump administration. What we saw in long-term interest rates for US Treasury debt was downward pressure on Treasury yields until we got to Liberation Day. And if you put this in context, right, between Liberation Day on April 2nd and I call the end of that window, I market where the 20-year auction tailed in May, and yields cyclically peaked for the year for 2025 year to date. That was what I'd call this open window. Like conditions were live, rules of engagement, all things are a go with the enemy, right? So between April 2nd, tariffs on, we roll them back, et cetera, et cetera, et cetera. We call it quits once the 20-year auction tails. It was kind of the episode of skirmish. It's been a rip in markets ever since. That same analogy, right? Things go live, Liberation Day to the May 20-year auction. I think when the Fed started cutting at this at the September meeting, we went back to live engagement again. And so to put this in perspective, once we went into shutdown, right? You have to think about it from the perception of what is each political party or their leadership who's in control of the political party or the coalition trying to achieve, right? We went through that last week. Now you got to think about what are the means through which they can apply pressure in a negotiation to achieve that outcome. And I think it is very clear that the Achilles heel of the US Treasury right now, we all know the fiscal situation. It's been well documented. US is really in no different of a boat than every other Western democracy in terms of its debt to GDP problem, right? But the US is sharply acute. Debt burden has reached a point where it's as big of a problem as it's ever been at the prior low points in its history. So American Revolution, Civil War, World War II. The Achilles heel to the executive branch's kind of side in this negotiation is long-term Treasury rates. So if you look at the chart, since the Fed started cutting, we set in a cyclical high. You've got a bearish engulfing, which means it's a candlestick technical analysis term, but it basically is a signal of downward pressure in terms of candle. Very simple. It's like you look at a prior day candle on an up move, it's green. The size of the candle on the next day is down or red, and it completely engulfs that prior day's high and low, right? So we saw that on the Fed cut. We also saw it heading into the Treasury shutdown on Monday when it became clear from a market's perspective that this was going to happen. Both of those things, or at least for the short term, suggestive of downward pressure and bond prices, or alternatively, upward pressure on yields. There's some key levels where the Treasury will step in, but same way, like at that same point of pain, the 20-year auction tailed in May 2020. That's when the executive branch had to step off the gas, stop playing offense, and go into retreat. That's where they say, "Oh, we're going to extend tariffs to July, August, etc. We're not going to put in force, this tariff table that we showed across like every country what rate they'd pay at the Rose Garden ceremony." If everybody remembers that graphic, famous graphic. We're in that same window right now. So the bond market is your key battleground, the long end rates. Watch this. Right now, the executive branch has the upper hand, in my opinion, to wait this one out. They hold the status quo. Possession's 9/10 of the law, right? So you have Congress, you have the Senate, you have the executive branch. All you have to do is wait this one out. Everything you need had been or every priority that they think they need to accomplish their agenda or what they want to get done was funded in the One Big Beautiful Bill Act. From now on, in terms of this shutdown, it's just ride it out, right? The open attack surface, as it always has been, is the Treasury market and or an uptick of inflation, which is much harder to generate, right? Generate inflation or cause job losses, et cetera, right? That would also put the or just say a softening in the U.S. economy. That would also put the administration on their back foot and have to let go of the gas, give some concessions in to the Democratic leadership. But really, the mark to market of where this battleground is taking place is in your long-term treasury debt. So for the time being, it looks to me like the risk in markets is really concentrated on long-term rates drifting upwards. But that's in a secular backdrop where the U.S. economy is slowing, demand for borrowing is out of balance. There's a larger suppliers or to be deployed than there is demand for borrowing money from private sector households. So all else equal, this is a primary wave where pressure on interest rates is down, right? For this little window, call it like 1 to 2 years, we're kind of sitting in. For the short term, kind of your secondary wave, the pressure is in the opposite direction. But if you're thinking about it, if you're viewing this from a Democrats versus Republican standpoint, which I try not to view things in, but in this one, the primary wave is in the Trump administration's favor as well. So you'd say tie goes to the White House. You always want the primary trend on your side. This is kind of a Jesse Livermore saying from reminiscences of a stock operator for market practitioners. But just wanted to use this week's roundup to really highlight the risks. Like this is a much riskier situation than I think the rest of that the broad market consensus is aware of at this moment. Equity still hitting all-time highs, all the above. This may actually be good for risk assets, right? Yields up is actually a positive correlation for Bitcoin and equity markets, the Qs, Mag 7, et cetera, over the last 12 to 18 months window. So rising treasury yields could actually add fuel to this rally in risk assets, as we're seeing from strength in Bitcoin, especially picking up, or it looks like since Saturday of this week, nearing an all-time high again. It's a very volatile window that we're sitting in right now. But one metric you look to, if you zoom out and look at the chart of the MOVE index, which measures implied volatility, expected volatility, or at least where it's priced for options on US Treasury debt, the implied volatility by the MOVE index, it looks like it's drifting. It's at very low levels, but you're starting to see little upticks. And this is where a Bloomberg article I was reading this morning called out. So if you look at moves of the move or vol of vol, right? You did see the sharpest 3-day spike since April. What was April? It was that window where I said the rules of engagement were live, right? Between these parties, these oligarchs, these, elites who are at conflict with one another, both internally and externally amongst each other with these 4 regional powers that I talked about. So you saw implied volatility index start to show rising levels, and we're bouncing off the low. This is still very early. This volatility, associated with this underlying situation may not develop. We may get out of this unscathed, avoid, some broader flare up, both from a market perspective as well as geopolitical engagements. That would be great. That's what I think everybody is hoping for. But I just want to call to attention, this could be the start of an uptick in all of those things.